Hello everyone and welcome back to another episode. I'm your host and millennial investor, and today we get to talk about my predictions for 2022. It's easy to look at all different companies in the stock market and try to guess where they're going to go into the future, and what you're going to see today is my 4 positions I have in my growth portfolio. Now typically we like to go over the 19 defensive companies in my dividend growth portfolio, but today we're only focusing on the offensive, high growing, concentrated positions that I have inside of my growth portfolio, which is Salesforce, Google, Amazon, and Crocs. And if you want to see my updated holding percentage weighting, you can see it right here. Currently, from top to bottom, the largest to the smallest, we have Salesforce, we have Google, we have Crocs, and we have Amazon. This has shifted a lot as stock prices have moved around as they bought and sold some of these companies, and don't expect these to stay the same forever, but over time these will move around as they buy and sell more of these companies, and of course they move up and down in stock price. Now keep in mind, really quickly, now I'm going to talk about all of these companies. All of these are just predictive assumptions. We're going to look at all types of things important for these companies: top line, bottom line, shares outstanding, balance sheets, future projections, and valuations. So stay tuned for all that. It's going to be a fun one. But before we get into all that, we have to talk about today's sponsor, MooMoo. MooMoo is a new up-and-coming brokerage that is taking the world by storm. Commission-free trading, level 2 data, advanced technical indicators, earnings calendars to see the date of financial statement releases, and institutional tracking to follow Warren Buffett's portfolio are just a few examples of what MooMoo has to offer. With this being my first sponsor in the channel, I have fully vetted their company and stand behind their vision. MooMoo currently trades on the NASDAQ under ticker symbol FUTU for FUTU and is SIPC insured. If you sign up below using my special referral link, you can get anywhere from 1, 10, or even as high as 20 stocks for signing up when you use my special referral link down below in the description or in the pinned comment down below. Free stock amounts can be as high as $1,000, so sign up now using the link in the description or pinned comment down below. You would help support me and my channel by doing so and give yourself an edge in the world of investing. Thank you so much, MooMoo, for sponsoring this video. Now back to the content. Okay, welcome back, and we're going to go ahead and get started in order from smallest to largest. So this starts with number 1, making up 21.7% of the growth portfolio, which is Amazon. Now this was my number 2 position and even my number 1 position for the beginning of 2022, and it's been my number 2 position for months. However, the stock price has tanked. If you look year to date, Amazon is down almost 50%. It's down 47% on the year, and on a 1-year basis, it's matching that performance. On a 2-year basis, it's down 43. On a 5-year basis, it's up 56, and then finally on a 10-year basis it's up 600%. Now 600% is still a decent return, but this is also Amazon we're talking about. It's one of the most impressive, one of the largest market caps on the planet, currently sitting just under $1 trillion. Now Amazon has done something recently in which they turned their profitability from an extremely high positive number to a big fat negative. They were originally in 2020 putting up $25 billion of free cash flow, and then last year they put up negative $14 billion. However, in 2022 they have recovered slightly from some of their low losses back at the beginning of the year, but it's still not looking pretty. They're still losing about $5 billion a quarter. Now, if we hop over into my little Amazon spreadsheet here, if you look at the numbers, you can tell that I go deep into the numbers for all the companies I invest in, of course. Now, one of the main reasons why I'm investing in this company, or I should say the main reason, is mostly because of AWS. And if you look at all these historical numbers, they're important to look at, but one of my key main bar charts that I focus on here is the AWS backlog, which currently has $104 billion in revenue in the gates ready to be acquired over the next several years. And also, if you look at my long-term projections for where I need the stock price to be at to hit my millionaire $40 goal, which if you haven't seen that before, this is what this needs to look like right here. That's a whole nother video. But if you go back to Amazon, you can see my bear, mid, and bull cases. Most of the profitability comes from AWS. If you look at this section that I'm highlighting, you look at the 2026 estimated revenue, operating profit, and which segment it's coming from. In every single scenario, the vast majority of the profits, and about every single scenario, about 70% plus in 2026 is going to be coming from AWS, and that's how you get these PEs based on where it needs to be at in 2026. And then we also factor in share dilution, price increases, and all that stuff. Now, Amazon is one that does still have a pretty healthy balance sheet. It's not perfect. It's not as good as it used to be, but their cash and debt is about even. You can see it's 58.66 versus 58.92, which is almost exactly even in cash to long-term debt, so that's still pretty healthy in my opinion. They are diluting shareholders slightly, but that's finally come to pretty much a halt. They're basically buying back a small amount of shares to stop dilution, and it's holding it pretty much flat right around 10.2 billion. The dilution is so small it's not even really worth factoring in, but for me, I think Amazon will continue to grow its top line pretty much no matter what happens because they're acquiring businesses, they're growing their core holdings, and more importantly, Amazon is just a growth beast that always finds a way to grow, period. I think the fourth quarter will likely be around a record number, and let me rephrase that. It will be a record number more than likely, and I think that Amazon will just continue to find a way to grow. So this stock price of $88 and change, I think is not going to be here long. I think $90 a share is kind of a joke, and long term we'll get back to the hundreds, maybe even one day into the 200, 300 range several years down the line. And this is one of the two companies out of the four that's going to be a long-term hold. Of the four in here, there are only two that I consider to be very long-term holds, and that's Amazon and Salesforce. So stay tuned for that. Next, we have Crocs, and I won't go over this one too much because I've made a lot of videos about it recently and talked about why I plan on selling out of this company, and the original reason why I decided to buy in was because the company was trading at a rock bottom valuation. Now notice today, based on today's close, it trades at $93 a share, $93.63 to be exact, but if you know where I bought my shares at, I bought in at $76 a share, which means that my investment in 2022, despite this horrible recession, has gone very well. So even after today's negative red day, I'm still up about 23% on my shares, and I currently have covered calls to sell my position at 115. Those of you that know me, I generate income by selling covered calls. That's how I make my money, mostly in the stock market from that, and then of course selling at a higher price. Same thing can be said for Crocs. They've really ramped up that revenue from the big acquisition, and the one thing holding them back, in my opinion, is mostly due to the fact that they have a horrible balance sheet, which is slowly getting improved quarter by quarter. You can see the long-term debt is going down by hundreds of millions of dollars each and every quarter, and the cash is long-term growing. So you can see as this will improve, I think the stock price will go up. However, selling just plastic shoes is not a business model that I'm honestly super confident in. There's so many other businesses to invest in. I do want to take some profits once this company gets back into the hundreds where it was just last week, and if it goes to 115, that's likely where I'm going to sell my position. Take about a 50% gain or so in just a couple months. If that could happen, that'd be great. We were almost there just the other day, but stay tuned. We'll see what happens. That's not going to be a long-term hold for me. It's very likely that I'll be selling out of this position in 2023. Next up, we have Google. Now, Google sits at a $1.2 trillion market cap, and Google is still growing like Amazon. They're at a 6% growth rate year over year. However, their profitability has faltered. Now, not nearly at the level that Amazon has, but their profitability has shrunk. As of the most recent quarter, it's went down 14.12%, and this is mostly because of advertisers on places like Google Search and YouTube, like you're watching right now. Someone who wants to put an advertisement on my videos do not have to pay as much today as they did 12 months ago. So if we go to Google and we just search men's shoes, for example, you'll see a bunch of advertisements pop up for Nike, for Men's Warehouse, and many others, and you can notice that these advertisements that show up look just like they were before, but they're not being bid at higher rates as they were 12 months ago. People might be paying 2 pennies per search, and now they're only paying 1.8 cents, or whatever the rate may be. Nonetheless, Google is making less money than they are right now, but I think when the recession ends and economic expansion continues, I think advertisers will begin to bid up what they'll pay for advertisements. One thing that I will note for Google is their powerhouse of a checking account, which currently sits at $116 billion. The debt is so small and negligible. At $10 billion, they have a net cash position of $100+ billion, which I've talked about many times on this channel, and this gives them a massive war chest to buy back tons of stock, which they've started to do. Just year over year, they bought back 2.23% of the company, and I think that that'll ramp up, and now is the best time to be buying back shares. Because if you look over the last few years, let's pull up the 5-year chart. When buybacks really started to ramp up, Google was at $150 a share. And you could be buying back shares at $150, and that's great, but buying back at today's prices of $90 or so is much better for the shareholder. You get to buy back many more shares for a lower price, and obviously actually counteract that shareholder dilution. I think that layoffs will likely happen in 2022 throughout the rest of the year and even in going into 2023 for Google because their costs have started to get a bit ridiculous. As you see, their costs have kind of skyrocketed. Even if you look at their G&A, their red lines, it is pretty much hitting new all-time highs year over year. Despite the revenue growth finally starting to slow down, you can see expenses are rising right alongside it, which is not good, and that's not what I want to see as a shareholder. Now, I think a year from now, it's very well that Google could be trading probably around, I don't know, maybe the 110s, the 120 range. We'll see how this recession goes. Hopefully that's where it's at. But nonetheless, Google is one that I'll likely sell out once we see a big recovery, once the expansion continues, and I can sell out for hopefully a decent profit. It's not a super long-term hold for me. And then lastly, speaking of long-term holds, this is the only one of the two other than Amazon that is going to be a long-term hold that I don't think I'll be selling anytime soon because I love the business model. CRM has a great lock-in on its customers. I've talked about it so many times on the channel, and they're hitting record revenue. As you can see in the most recent quarter, they just hit a record, still growing 14.19% over the year, and profitability, which is going to be coming in very soon, is going to be hitting its all-time record. I think that profitability for this year is going to end up around 6.3 to 6.4 billion, and last year's profitability was 5.28. It's going to be growing profitability somewhere around 15-20% just in the year-over-year basis. And actually, based on their projections, they said that it will likely be closer to the 20% range, but still, nonetheless, $6+ billion of profit for a $130 billion company is not bad when you consider that this is a software company that's still growing well into the double digits despite this recession. This is one of the lowest growth rates they've ever put up at 14%, and that is still pretty good in my opinion. The company is long-term profitable. The shared dilution issue, which has gone up and up, which is a bad thing for shareholders, is finally starting to come to a halt. Notice how every single quarter they issue shares, and then finally in the most recent quarter they stopped that because they're starting to buy back shares. Now they still have lots of cash on the balance sheet. They have more cash than debt. The cash pile is 11.92 billion. The debt is 8.85. So they do have a positive net cash position when you consider the fact that this company has more cash than debt on its balance sheet, and it's still obviously putting up positive free cash flows. Going to finish out this year around $6.4-ish billion throughout the year of 2022. Now, these are all four companies that I like, and I think that Salesforce, in my opinion, is going to be a great performer on a 5-year period. The fact that this company has grown so much in 5 years, and it's only gone 28%, is ridiculous. Look at where the revenue was 5 years ago, and tell me how that makes just economic sense. It doesn't. Revenue has doubled over the last 5 years, over doubled actually, and profitability has done a very similar story, over doubling in just 5 years, and the share price has gone basically nowhere. So this is one that I think will recover a lot in 2022. I wouldn't be surprised if it's at 160, 170, maybe even 180, depending on how good it does. But nonetheless, it's one that I'll be holding for the long term and will likely continue to be the number one position in my portfolio. Thank you guys so much for watching. Appreciate you watching all the way to the end. Check out MooMoo down below if you haven't already. But thank you guys so much for watching, and I'll catch you all next time.